I've got the two monitors going, and one of them has our Zoom thing up here, and the one over here has our slide deck. So not
so you'll be back and forth between the two.
I'll be looking between the two, but hopefully that won't be too distracting for folks.
That's great. I'm seeing we have a couple of attendees joining on already as well. So welcome to those of you that are coming on a few minutes early and testing out. And our presenters are here and ready to go, and we'll be getting started promptly as close to 10 o'clock as possible, and just waiting for a number more attendees to join on.
So Matt, I guess where you're driving, you have to move the slides then?
I'll be moving the slides.
Sorry, I was doing something else and okay.
I will try not to.
No, it's all good. My stuff is pretty, I'll let you know if we're in the wrong spot.
Yeah.
Good morning again, everyone. I'll just wait for one more moment. We have a few people still joining on, and just want to allow the rest of the attendees that had pre-registered to get into the room before we start with our session.
morning. I just started a video Zoom meeting. Zoom? I don't know, it's a government, it was just starting. Excellent, thank you for telling me. I've been praying for you every day.
So good morning again, everyone, and welcome to your webinar Wednesday series event for today. Hard to believe it's actually November 4th already, and we have survived our first snowstorm and all of the fun commute that went along with that. For those of you in HRN, it was a bit of a snarl last night, but this morning the sun is shining, and we are absolutely thrilled to be joined today by our partners from Grant Thornton. And they are going to be sharing with us today a session focused on leveraging government supports and a focus on cash flow. And obviously, as we've continued with the many months now into this pandemic, we're hearing continually from operators around the challenges of accessing government supports and programs, resources that will help with their operating costs and ensure that they can keep their doors open. And with some recent announcements from the federal government regarding some existing programs being extended or adjusted. And then also with the recent announcement provincially that the commercial property tax rebate program was being announced. This is a very timely topic indeed. So we are very pleased today to be presenting this session. It is being presented with support through the Tourism Reactivation for Industry program, which is an initiative being supported by Tourism Nova Scotia and delivered through tie-ins. As we hear from our experts from Grant Thornton today, I really want to reinforce to you that all of this information and customized one-on-one support on preparing applications, rebate supports, and just sourcing out the best information you can have for financial supports for your operations, we can support that through the TRI program, and you can have access to these expert advisors and a team in your own community one-on-one through the TRI program. So please do reach out to us, and we'd be happy to make that happen and facilitate that connection. So I'd like to present and hand off to JP Fury, and also we have Matthew. I'm not going to get it quite right. It is MCMAC.
McAdam.
It's McAdam. It's not MacAdam. It's McAdam. I know there's often that debate, right? But we're very pleased to have both of you joining us here today to share again your perspective on some of these resources and supports and some of the things that the tourism operators on the line today should be considering as they're looking forward, in particular into the winter months when cash flow is becoming, in many cases, even more constricted than it has been for the last little while. JP and Matt will present their session, and we will have opportunity for a Q&A. We will be monitoring the Q&A box as well, so please do feel free to post your questions in there, and we will do our best to get to them either through the session or at the end, and if not, we will reach out to you afterwards with direct one-on-one support. So without further ado, I'll hand over to JP and Matt.
Thanks, Lisa, and we're happy to be here. And I mean, we did a number of sessions since March and with you guys as well, and quite a bit continues to change, as you said in your introduction. So we're going to focus on those changes today, along with a little bit on managing your cash flow. So if we could just go through the next slide. I think it touches on, it introduces us again, but we're introduced. You can see our faces here. I'm a principal in assurance, and Matt is actually our Nova Scotia tax leader. So he's been involved both provincially and across the country, getting updates on these programs and changes to tax legislation as we navigate it through everything since March. So he's a good resource to have on the call. So in terms of the agenda, we've already done the welcomes and introductions. I think there's going to be a heavy focus on the Canadian Emergency Wage Subsidy, and this is a program we presented to this member base previously, but there's been a number of changes. The program's been extended, and the access to the program is now changed and might open up access for entities that didn't previously have access. And as I said, then we're going to talk as well about cash flow and the ability to leverage real-time information through cloud accounting to get even better cash flow. So the next slide, I think, talks about the landscape at a high level. There's a number of programs listed here, and by no means is this a complete and comprehensive list, but this is some of the more popular ones. And as I said, we're going to talk about the Canadian Emergency Wage Subsidy today, in particular, the recent changes that may open up access for some folks. We're also going to talk about the Canadian Emergency Rent Subsidy program, and one program that's not listed on our list here, but Lisa already mentioned, the real property tax rebate program, which is a provincial program. So we're going to talk about those three programs specifically, and then cash flow from there. So starting with the Canadian Emergency Wage Subsidy, we typically spend the most time on this, and for good reason. The last estimate I could find last night as I updated my knowledge was that this program will cost our country just under $60 billion. It by far is the biggest program, and we will separate into Qs 1.0, which is what we already presented on and we'll touch on. And with Qs 2.0, the access sort of opens up a little bit more based on having still a decrease in revenue, but the thresholds aren't as big. So the next slide just talks about the eligibility, and just a quick reminder, and we would have presented, and I'm sure folks on the call have accessed the program to date, but almost all entities are eligible. It's easier to talk about entities that aren't eligible, which would include, for the most part, government type agencies like universities, Crown Corps, etc. If you fall anywhere around the peripheral of that bucket, we can discuss whether you'd be eligible or not. You need to be an employer, and once you have employees, eligible remuneration is what the calculation's based on, and essentially that includes salaries and wages and some other benefits. Doesn't work in all rules, but typically taxable benefits are included, but there are some gray areas where we need to look into that. Things like severance aren't included. So your standard payroll salary costs are, and outside of that, sometimes we need to look at the details. And as I already mentioned, there is a revenue test, which is the most important part because that gets you access. And that's changed significantly for the new claim periods in terms of the extension, and we'll go into that today. So the next slide talks about some elections that are in place, and I remember I was on the previous presentation to this group, and some of these elections are more or less relevant to this group. I think the prior year reference period, which is a January-February average, early on wasn't as relevant because those months traditionally for this industry are low revenue months in terms of setting your benchmark there. What's interesting is for 2.0, now you're looking at months like the fall and early winter, where you may have lower months as well. So you might want to consider that benchmark. So it's important to note that for 2.0, you can reset these elections. I probably should have said that at the onset, but it adds a level of complexity. I understand some of these elections were complex to understand in the first place, but now you need to look at a little bit of a forecast in terms of, does this average of January, February make sense? There's the cash method, which is, normal accounting, potentially for your tax return or your financial statements, depending on what you're preparing for on an annual basis. Use an accrual base of accounting. you may be able to change that to cash base, which you could do an analysis on whether that makes sense. Seems less relevant in this industry in terms of consolidation, but there are a lot of entrepreneurs that have multiple business interests. And what the consolidation election allows you to do is look at those business interests together. And you may have one business that's down significantly and another that's not. And by looking at the revenue test together, you access more credit. So like I said, some of this stuff can get complicated. And there's also been some clarity now on the ability to go back and either adjust or cancel previous terms. So that's why before, when we were presenting, we were less clear on can you amend or not. So I'm not going to go too much into the elections other than that. I think just being aware that they're there as you work through this it is a good starting place. The revenue test is really the starting point, and we're going to go into, or Matt's going to go into on subsequent slides, this in a little bit more detail. If you were in the previous presentation, we would have talked primarily about 30%, which was the benchmark. You needed to have at least a 30% decrease for months April through August. That was split in half for March because the pandemic the impact of it kind of started halfway through March was sort of the high level logic. Now, the interesting thing from July till December is any decrease qualifies. However, it doesn't qualify at the same rate that the 30% decreases qualified previously. So Matt will touch on that in the subsequent slides. So with that, I think I'll hand it over to Matt to go through a little bit.
That's perfect. Thank you, JP, and good morning, everybody. So what I'll do is take you through a bit of the nuts and bolts on the CEWS program to not every detail, because we would certainly need a lot of time for that, but certainly to give you an overview. And in particular, as JP mentioned, the second iteration or the second version of this program, what we dub CEWS 2.0, and you'll see some distinctions made between the two and some comparisons made between the two as we go along. But as JP had mentioned, both iterations of the CEWS are based on a revenue test. Both apply a subsidy based on eligible revenue, eligible remuneration that an entity has, but there's definitely some differences, as we'll see as we go through. So at a glance, in terms of this slide, so you'll see for periods 1 to 4, as JP mentioned, it was a 75% maximum subsidy. And in order to get that, you had to have met at least a 30% decline in revenue, 15% for the month of March, but 30% for periods 2 to 4. And if you met that, you could get a 75% maximum subsidy. What's new with CEWS 2.0 is for periods 5 to 10 onward, it's still a revenue test, but any amount of drop in revenue will get you some amount of subsidy. So it's no longer a bright line 30% test. And what happens is the extent of your subsidy will depend on your extent of revenue decline. And we'll see that kind of as we go. So just to kind of recap CEWS 1.0 so that we can differentiate between the two. And this is certainly a rehash for anybody who had been on the previous presentation on this. But this is what it looks like. You'll see there's actually reference periods from March right through to August. And you might wonder why July and August are on there. I will come back to that, but there is some overlap between the two rules, or some interplay between the two rules, kind of as a transitional provision. So I will speak to that as we move through the presentation. But what you'll see with this is it's a current reference period to prior reference period comparison. So as JP mentioned, that can either be current month to same month of prior year, or it can be average of January, February of 2020. And I imagine, you know, for the most part in the tourism industry, unless you're a winter-based operation, the similar month of the prior year is probably the way that you're going to go. As JP alluded, there is a reset on that. So you'll see on this table, when you get past June, you can actually adopt, if you went with, for instance, method 2 as your comparative reference period for the first 4 claim periods, you can hit a reset on that and go with another route for the remainder of the CEWS program. But once you make that election or determination on which way you're going to go for that July period, you're stuck with that then for the remainder of the year. So it's that one reset opportunity that you have. So as I mentioned with CEWS 2.0, your subsidy amount actually fluctuates or varies depending on your extent of revenue decline. And the percentage of the subsidy is based on 2 components. So one we call the base percentage and another a top-up percentage. Both amounts are directly correlated to the revenue decline. So the higher your revenue decline, the more that you will stand to get from the subsidy. And the rules related to this, again, just to rehash, apply from periods 5 through 10. As you know, in the speech from the throne, the government has committed that they would continue the CEWS program into 2021. I think as far now as June of 2021. We don't have all the details in terms of how that is going to work mechanically. We're assuming it will look very similar to the current CEWS version 2, but that has not been put into to law at this stage anyway. So. Okay, so here's the same table, but this is the version 2 of the CEWS, and you see that July and August are popping up there again with some asterisks, so I will speak to that in a minute. The key point there is kind of that middle column, percent RD or percent revenue decline. Any amount of revenue decline gets you in the game with this subsidy. So the government really wanted to broaden this and to make sure that that all businesses that were suffering some amount from the COVID pandemic were going to get something. And I think that the way that they've done this is more effective, perhaps, than having a bright line test at having to hit a 30% threshold, for instance. The base percentage, so the column after that, the second last column that you'll see here, is the base percentage. And the way that's calculated is by determining your revenue decline for the given month and multiplying that by a factor. And you'll see the factor for the first period 5, July, that factor is 1.2. And you'll see it starts to go down. By the time you get to September, it's 1.0, and then from October onward, it's 0.8. And in fact, what the government had planned was a complete phase out of this by the end of December. And that's why you see some marked out amounts there for November, where they were going to take it down to 0.4 as the factor. They've when they extended this to the end of December, they decided, no, we're going to leave that in place at a minimum of 0.8 as the factor. The number in brackets, so the 60%, 50%, 40%, that's the maximum. So if you had a revenue decline of a certain amount, you multiply it by 1.2 and it yields, let's say you're dealing with July, it yields 70%, your maximum is going to be 60, okay? So that's the base percentage. The next component of that is the top-up percentage. And the top-up percentage is for those entities that have experienced an extreme drop, an extreme being measured in something in excess of 50%, then there's an additional top-up that they can add to their base percentage in terms of calculating their subsidy amount. And the way this works is, instead of looking at 1 month, you look at the previous 3 months, and you aggregate that and compare it to the prior reference period. If you chose, say, same months of prior year, Then for July, you'd look at April to June 2020 and compare it to April to June of 2019. If your revenue decline over those 3 months in aggregate is greater than 50%, then you qualify for a top up. And the top up is calculated as whatever that excess is over 50% multiplied by a factor of 1.25 to a maximum of 25%. So I will go through an example which will perhaps illustrate this best. So if you take a look at this, there's a bunch of data here, but we're really going to zero in on the October month. So you see in October, we're comparing our October 2020 revenue to October 2019, and we've experienced a revenue decline of $50,000 or 50%. So to calculate our base percentage, we will take 0.8, that's our factor for the month of October, times 50%, that was our revenue drop, we get a 40% base percentage. And then we look to see, okay, do we also get a top-up percentage? And we'll look at the previous 3 months and see that our revenue decline was 70, 60, and 50%. The average of those over the 3 months is 60%. And where 60% is higher than 50, that 10% difference gets multiplied by a factor of 1.25 to yield an additional 12.5% that adds to our base percentage. So our combined subsidy percentage for the month of October is 52.5%. So in addition to that, there are some extending and some deeming rules which help with the overall qualification of the program. So you might remember from Q's version 1, if you qualified in a certain claim period, you automatically qualified for the next claim period. So if you had a revenue drop in April of 30% or higher, you automatically qualified for the claim period of May, irrespective of what your revenue drop was for May. Well, because there's no 30% bright line test, they had to change that deeming rule for the second version of Q's. So what it is now is that you calculate for your determining your current period revenue decline, you calculate it for your current month the way that you normally would, but you also calculate it for the immediately previous month. And the higher of those two is the one that you can use. So this is particularly useful. It's again designed to give some certainty to businesses to say, okay, well, you're not going month to month at least. You know that if you had a minimum subsidy amount in July of X, you've at least got that same revenue decline. You're deemed to have it for the month of August. So it gives you some predictability in terms of determining how you plan your staffing. What's also interesting with this, though, is that you can qualify for the subsidy even in a month where you've had an increase in revenues. So if you had a decline in a particular month, but the next month you're up, you can still look back to that previous month. And there's a quick example here of that as well. So just quickly looking at this, again, honing in on October, instead of a revenue decline of 50,000, we're actually up now by 150,000. So no revenue decline in October at all. But when you go down through this, because you can look back to September and use September's revenue decline for purposes of your October claim, you actually get to the same, you get a subsidy, and the math works out the same here, but it's basically the 52.5%. Because he had a 50% revenue decline in the month of September. I mentioned kind of that overlap for the July and August months. So this is particularly useful. This was, the first version of the Qs ended, I think July 4th was that, that eligibility period, and the reference period would have been June. And then we kind of start this new program from July onward. But to help with that transition and to help businesses navigate the changes in the rules, they said that we'll implement a safe harbor rule, which basically says that for the months of July and August, you can calculate your wage subsidy using both of those methods, the former version of Qs with the 30% bright line test, or this new one using the base percentage and top up percentage. And the higher of those two you can use as your basis for your claim in July and August. So particularly useful in terms of helping businesses navigate that transition. Creates a little bit more extra work in terms of trying to understand which is better, but certainly can provide a better result. So again, because I'm an accountant and I like numbers, I'll go through another example. So in this case, we're looking at April, May, June, and July. The numbers here are pretty much the same as the first example I think we went through, where July has a 50% reduction. So calculating it under the new version of Qs and looking in reference to July, we have a base percentage of 1.2, that's our factor for the month of July, times 50%, which gives us a 60% base percentage. We do get a top-up percentage as well of 12.5, which takes us to 72.5%. But we know as well that in the month of July, we had a revenue drop of 50%, which was higher than 30%. And therefore, under the way we would do this under the old rules, because we were higher than 30%, we'd automatically get a 75% subsidy percent. So for the month of July, under the safe harbor rule, we're able to elect to use, it's not actually a formal election, but you submit your claim based on the calculations using the old method. So last detailed rule in relation to this is a second safe harbor rule related to the top up. So the top up, as I mentioned, is a 3-month trailing calculation. So you look at your previous 3 months, determine your average revenue decline over those, and that defines whether or not you get the top up and to what extent you do. What the government had proposed, and in fact, in looking at some recent legislation that was drafted this week, it's contemplated in that legislation, so we expect it to become law. The top-up percentage, the top-up calculation for the month of October onward can be the greater of that 3-month calculation or just the single month comparison. So you take, for instance, October, you could do your top-up calculation using the trailing 3 months, the July through September, or you can opt instead to look just at October and do your calculation based on October and whichever reference period you've elected to use for October. What this is designed to help with is situations where businesses have a significant downturn that occurs suddenly, perhaps over the second wave. So they're kind of trucking along, but then things really turn sour in a particular month here, October, November, or December. This can be a significant help in terms of getting them the top up where it would otherwise get watered down because of stronger months in that three-month average. And then there's a quick example here. I won't go into too much detail in this, just in the interest of time, but what you'll see is based on the trailing 3-month average, your top-up percentage calculates to 12.5%. But if you look at it simply in relation to October and your revenue decline for October, where it was 70%, you can opt instead to use that as your basis for calculating your top-up percentage, and you'd get the full 25% in that instance. So that's it for numbers, I promise. But maybe I'll just close with a few other points on the wage subsidy. before we talk about a couple of the other subsidies here. One other distinction that I want to mention in terms of the wage subsidy difference between periods 1 through 4 and period 5 onward is eligible employees are defined in the same way, but in the first version of Qs, you actually had to go in and look at any employees who were without remuneration for a period of 14 consecutive days in that claim period. If you had employees that were without remuneration for that length of time, they were ineligible to be included in the wage subsidy. There's no such requirement under the second version of Qs, which is great. Because frankly, when you get into these calculations and going through the detail, especially if your organization is fairly large and you have, term employees and employees coming and going and that type of thing, it can get quite cumbersome trying to figure out who was there for the required periods in order to be able to include them in the calculation. So that is definitely a welcome change. So just a few other considerations in terms of it. You can only claim the subsidy after you have paid the employees for the relevant period. So you do have to make sure that you have paid them in order to claim the subsidy. So certainly pay your wages first and then claim the Qs. I haven't seen in my experience where that has ever been an issue. But it's nonetheless a point to consider. There's no overall limit that employers can claim, so there's no ceiling on this subsidy. But you must apply each month, and for obvious reasons, because the extent of your subsidy amount and your ability to qualify to some degree is dependent on your performance month to month. And then the last point in terms of keeping documentation, and this is very important as we're starting to see some activity from the CRA on this program now. It's very important that you keep all your documentation related to it. So what your calculations are, how you determine your revenue declines, how you measure your revenues, the payroll calculations, and then even those elections that you make in that Form RC 661. Having that all on file. We have seen some inquiry letters now from the CRA coming out on the Qs, and they're fairly extensive in terms of the information that they're looking to see. So having that all ready is definitely to your benefit. Just very quickly, how to apply. I mean, most businesses who have qualified have likely applied already for at least one claim period. So this is fairly familiar, but you apply using My Business Account on the CRA website, or you can have an authorized representative do that on your behalf. Or failing that, there's an ability to do it using a web forms application and a web access code. Certainly in most cases, we see the first two options being what's used. I will say in terms of the timing of this, and this is a good thing as well, because there are perhaps some businesses who've not been able to navigate this, or just the extent that they've got to operate their business on top of trying to do these subsidy programs. It can take some time. The deadline for filing for any claim period right now is extended to the latest of January 31st, 2021, or 180 days subsequent to the end of the particular claim period. So it's not a situation where you might be looking to file for December 31st or the December 19th eligible period, and you got to get your claim in by January 31st of 2021. You've got that 180 days subsequent. So, and then, as I mentioned, the government had announced some changes on October 9th. To extending it to a minimum of December 2019, with the intention to extend it to June 21st. And there was a bill that was put before Parliament for first reading just on Monday Bill C9. I reviewed it for the first time quickly yesterday as I was preparing for this. And I haven't been through it in great detail, but I did see there's no real surprises in that legislation in terms of what we expected for queues up until the end of December. And unfortunately, doesn't seem to be too many details yet in terms of how the queues is going to carry into 2021. We know that it will, but we don't know, for instance, if there's going to be changes to the factors used in, for instance, the base percentage and those types of things. So that's about it for the Canada Emergency Wage Subsidy. I'll speak fairly quickly or at a high level on another significant subsidy, which was announced as well on October 9th. And there is actually legislation related to this in Bill C9 as well, which is good to see. I haven't had a chance to crawl through the legislation in great detail, so there will certainly be more coming from our firm on this in terms of some information that we'll disseminate on our website, and certainly we can look to do an update on this at a future time when there's a bit more clarity. But this will also be a significant and wide-reaching subsidy, and probably one that is significant to the membership on this call. So this was a rent subsidy, not a wage subsidy. It was announced for eligible businesses. It was first announced October 9th, and the legislation was produced just this past Monday for first reading. So it is not law yet, but it's going through the process now. What it looks to be is a subsidy for tenants of up to 65% of eligible rent expenses. And it will also be revenue based as well. So it will look to the extent of revenue decline and the extent of that subsidy to the maximum of 65, but it will be on a sliding scale based on revenue decline as well. It is retroactively going to take effect back to September 27th and up to December 19th right now. It looks like it'll be a claim period format similar to the queues. In terms of how to make the claims and that sort of thing, I don't think there's any details yet from finance on that. But certainly once this becomes law and enacted, businesses will have the ability to go back and make these claims to recover some of their rent expenses. There is also a top-up subsidy component to this one as well, and it looks to apply to organizations that are or have been impacted by a mandatory health order to shut down. So, you know, if there are any businesses that were forced to shut down because of a health order, there is a particular additional help through the subsidy for that. So unfortunately, that's the extent that I can really communicate definitively, and I know that's very high level, but as I mentioned, as we get some more details on this, hopefully we'll be able to disseminate that, as I know this will likely be a particularly important and relevant subsidy for some of the membership. So with that, I think I will turn it over to JP again. JP is going to talk a bit about the new tourism accommodation property tax rebate.
Thanks, Matt. And I know the Canadian Emergency Wage Subsidy Program, with all the, it's not that it wasn't complex before, but with all the changes can be complex. So we are here to help folks if they need help after this to navigate through that. This particular program, the tourism accommodation real property tax rebate, is much easier to explain. It's very new though, so I haven't seen it as much in practice. But essentially how it works, and it's a good news story, there's a potential one-time partial rebate of 25% of your 2020/2021 real property tax that's been paid in full. The eligibility for this, which is outlined on the slide, we can share this slide if it helps folks. At a high level, you essentially have to occupy a qualified roofed accommodation, and you need to either own that or lease. And if you lease it, you need to be responsible for paying the portion of the property tax that relates to your leased portion that you're then using as a roofed accommodation. There is a revenue test, and the revenue test is essentially a 30% drop in revenue for the period of April 1st through October 31st, and you need to be registered under the Tourist Accommodation Registration Act. If you happen to this be your first year of operation, there is some allowance to still access this, but the revenue rate increases to 50%. So that's this at a nutshell. It seems fairly straightforward. I will say, with the caveat, we haven't seen this in practice yet, but the province has this same information on their website, and has made the program fairly easy to understand, which is good news. So from there, I'm going to talk about the importance of managing your cash flow. And I'm going to try to leave us some time to have some questions. I've seen some in the chat, so I will I'll be cautious of that as I move through this information. And first, we're just going to talk about some classic points that we talk about in cash flow: the importance of monitoring it, either to ensure you stay in business, manage your working capital, maybe manage banking requirements, or in this business, which is particularly interesting, or industry, it's managing the seasonality and making sure you have enough cash from the peaks to get through the valleys. And that's now particularly another layer of complexity and challenge with the slowdown that we've been seeing as it relates to COVID. So really, we're going to talk about and look at a little bit of an example. I'm only going to touch on it on a very high level. But by doing proper cash flow management and by looking at the level of granularity, you're able to prepare for the situations I just talked about, and better talk to your banks and stakeholders to ensure you have the cash flow you need. If you're accessing programs like CEWS, you may know the urgency. As Matt said, you can wait to apply, but if you're going to have a cash flow crunch, you may want to apply earlier so that you get that cash earlier. So the next couple of slides shows sort of, on the first slide, cash receipts in a model, and on the next slide it'll show outflows. And one thing important I like to highlight about this model, you'll see the time periods on the top, and they're weekly increments. And a lot of times when folks businesses do cash flow, they do by monthly increments. And sometimes you don't get the level of granularity or realize things by doing it in those increments. I often talk about payroll. Payroll is something that could be done bi-weekly, could be done weekly, could be done semi-monthly or monthly, depending on the way you structure in your business. And I find when you do monthly cash flows, you might average that out and not catch, for example, there's 2 months in a year if you do by weekly, where you get stuck with 3 payrolls. So by getting to the granularity of monthly or weekly, you realize where those real stress points in terms of higher cash outflows are going to be. You know, it could be things like property tax, or like I said, payroll is a common one that's mismodeled on a monthly model versus a weekly model. And what this does is allows you to make more informed decisions, but also, you just go to the last slide in this model, demonstrate to your stakeholders, whether you have a line of credit with a bank or you have other business partners or people with interest, where you're going to be, and be proactive, particularly with banks. It shows here at the end, if you're offline on your operating line, you really might know, I'll only be offside for a week, but it's good to be proactive with your bank and demonstrate that level of knowledge. So this particular model here, you know, is a very high level. It's just showing inflows and outflows, but by going to the granularity of weekly, you do get a little bit more power of information. And we have helped clients implement this, whether it be for a financing, a bank relationship, whether it be ongoing or refinancing, or just simply to make sure you're making it through the peaks and the valleys. So I show it with that. On the last slide relating to the cash flow, we tie in sort of cloud accounting. So what is cloud accounting? And a lot of people will have accounting systems like Simply Accounting, or you know, maybe QuickBooks in this industry, and they might be desktop applications. What cloud accounting does is essentially move that to a web browser or an app, so you can access the information in real time from anywhere, whether it be you're in the office or you're home on your phone or iPad or home computer. And what it also does is leverages some automation by pulling in bank transactions in real time to give a little bit more efficiency. And that real-time information helps make better decisions. And when we map that into a cash flow model and update it in real time, it can be really, really powerful. Enables you to have business health checks, and the banks, in terms of lenders and stakeholders, really like the frequency of information. Once everything is mapped to a cash flow model, they particularly like that. So this is an area as well where we help clients anywhere from what I call virtual bookkeeping, so just making sure your transaction flows are up, to some virtual advisory controller type, CFO type advisory services through leveraging the cloud. And it helps us as advisors because we also have access to your financial data in real time. So just trying to be cautious. We said we'd have 15 minutes for questions. We'll have about 10. I'll touch on, before we go through, just we have, and Matt alluded to, we have a great website that has all the resources in more detail. You know, Matt was talking about a program that just came out. As soon as we get clarity on that, we will have, you know, a brochure available through this hub. So the Grant Thornton, you know, our site is grantthornton.ca. On there, look for the COVID hub that has, you know, brochures and information on everything that we talked about today. If it's not there yet, it will be in the future. In terms of some of these programs are very new, but this is sort of our intersection for information. So I encourage folks that are looking for more information to go there. With that, I think we've covered everything in the deck, and it was a lot of information. So I'm happy we got through in 50 minutes. I think there's some questions logged. Maybe we could start there, but I'll turn it back over to Lisa to monitor the Q&A.
Perfect. Thanks so much, JP and Matthew. That's a lot of great information, very timely and practical. And I think in these days, this is particularly helpful for operators that are looking for the most efficient way from point A to point B with these programs and supports. One of the questions that came up early on in the Zoom chat is around the wage subsidy piece and the clarification around operators that are small businesses who are owners and pay themselves a salary or wage. That is an option for them to avail themselves of that program. So just sort of clarifying that process. Early on, it was not an option, but then there were some changes made to that program. Yes.
Yeah, that's right. If I may as well, Lisa, just a point on that. There's some complexity there because there are limits, as Lisa had correctly pointed out within the text chat there. So there's a concept of base remuneration when it comes to what they call in the tax world non-arm's length employees or related employees. So what I'd suggest there is reach out to your advisor if you have a situation where you're trying to claim the Qs in relation to owner manager salaries. And certainly if you have any questions specific in that regard that you want to reach out to us, we're happy to help as well.
Perfect. All right, I believe that that was sort of the main one. And what I have done though for our participants is I've taken off their restrictions in terms of speaking. They are muted, but for any of our participants, if you'd like to unmute yourself and ask a question, you do have capacity to do so. So we'll take a moment and just see if there's anything additional from our participants that they'd like to pose and ask our experts online. I've got a question from Mary Eldridge. Mary, I'm just going to make sure that you can get yourself off mute there.
Can you hear me?
Yes, we
Yes.
can. Hi.
Hi. We run the local museum. Our budget's about $350,000, $400,000 a year. The town taxes us $95,000 and they give us a grant. They used to give us a full grant. This year we had to pay almost $15,000 on our taxes. Can we still, what they do is we pay the taxes and they give us a grant to put the money in our bank. Can we apply for that 25% rebate? We are a tourist entity. Even though we got a grant from the town, can we still apply for a 25% rebate?
I might not have the a full answer for you, but let me ask you a couple questions. So you have a lease for the museum, or do you own it?
We own it.
You own the building, and the local municipality gives you a credit by way of grant related to that. Is that grant for 50%, 75%? How much of the payment is it?
Well, this year the grant was, the taxes were around 95,000 and the grant was 80,000.
Okay. Yeah, I might want to, just because the rules are new, to be honest, I can't see anything that would prevent you from claiming the grant. However, there's an overarching theme in some of these things around stacking, and I just would want to look into this with the province to see what the answer is.
Okay.
I don't know if Matt has anything to add.
Yeah, go ahead, Matt.
Yeah, no, I don't, JP. I think our suspicion is it probably does and probably should qualify. But as JP has pointed out, the devil with these programs is in the details, and there's always little nuances like the one you just described, Mary. So we will take that away and see if we can find an answer for you on that.
Okay.
Mary, we can follow up post this webinar direct with you and connect you to some supports through Grant Thornton to help you navigate that, okay?
Yeah, that would be good. Thank you very much. We do find it very difficult to pay any portion of our tax at all because our revenues are very low. We have to depend a lot on an endowment as well.
So
Thank you
we'll
very
follow-
much.
Thank you, Mary. Thanks
Thank
for
you,
that
Mary.
question. Anybody else want to chime in with anything they have for a question or query? I know we have a range of operators on the call as well today. Some that are accommodation operators, some that also have campgrounds. I guess the last thing I would probably ask is, is there anything else in addition to this that operators need to take into account? I mean, we're kind of heading into tax season, dirty words at this point, I know, but very soon. And so, you know, given the fact that we've been, as an industry, coming through one of the definitely most catastrophic experiences that we've ever seen from a sector perspective as well, is there anything that operators should be planning now or shoring up now or thinking about now heading into the next few months in advance of tax time?
Yeah, I think that's a great question, Lisa. I think a couple of things come to mind. First is, you know, any of these subsidy programs that you avail yourself of, you always have to remember that that is government support, and government support is taxable if you are a taxable entity. You know, where, for instance, with the Canada Emergency Wage Subsidy, you can obviously deduct the wages that you're paying to your employees, but if you get a subsidy through the program on that, that will contribute to your overall tax result. So bear in mind that. The other thing, as we've seen over the course of the summer, with the lockdown and some of the difficulties that businesses were experiencing, there was a push out of a lot of different administrative requirements under our tax system. So, for instance, filing deadlines for different things were pushed. There was even some leniency towards HST deadlines and when you have to remit HST collected. And I think, as most people are aware, those measures and those leniencies have pretty much run the course right now. We're back to business as usual in terms of filing deadlines for the current time frame. But it'll be interesting to see as we kind of approach compliance season again, and certainly a lot of businesses operate on a calendar year basis for filing. It'll be interesting to see, I guess, whether or not there's similar leniencies that are granted as we get into the new year.
Awesome. Well, I want to just say thank you so much to both of you for taking the time to share today's presentation with us. We'll continue to look for ways to connect existing industry requests out to those, those advisors and those supports with the Grant Thornton team around the province, and other relevant supports as needed. Two quick things I wanted to close with today for our attendees, and that is that we do have our exclusive event, which was announced last week, coming up on November 24th. We are hosting an in-person event with retired General Rick Hillier, a leadership event, an inspirational event, an opportunity for us to come together and try to navigate our way forward together in these really difficult times, but with looking towards the future and what could be. So I'm encouraging those of you that are with us today that haven't done so yet to read through our bulletin, jump on Tourism Strong. The information is there to get your complimentary ticket as a tie-ins member for November 24th at the Westin, where we will be respecting all social distancing requirements, but hosting an in-person event and encouraging industry to attend. The other thing I wanted to encourage people to be aware of is that this is presented today as part of the TRI program. And I wanted to encourage people to reach out and ask us for support and assistance. And thank you to Tourism Nova Scotia for their support of that program as well. JP and Matt, thanks so much for your time today. I wish you all on this call a great afternoon and look forward to reconnecting soon. Stay well and stay tourism strong, everyone. Take care.
Thank you.
Thank you.
Bye-bye.
Thank you.